On Business Incorporated today, human rights activists urge Biden to push for intellectual property waiver for COVID-19 vaccines. Senegal signs $1 billion of construction deals with U.S. firms. Kenya and South Africa to discuss post-COVID revival as Ramaphosa hosts Kenyatta. Hello and welcome to the program. I'm Chimize Obi Iwago. First, the markets, and starting off with trading activities from major equities markets here on the African continent. Nigeria's NGX and South Africa's indices traded in the positive territory. The NGX was up 6 basis points. South Africa's JSE index was also up over 0.5%. Egypt's EGX 30 was also in the green, up by 0.81%, while the Nairobi Stock Exchange closed Friday's session in negative territory, down 63 basis points. We cross over now to the Middle East, where major equities were mostly negative at intraday except Abu Dhabi. The Abu Dhabi index was up 45 basis points. Meanwhile, Dubai's indices is down over 1%. Still within the region, Saudi Arabia and the Qatari indices were in negative territory, down 1.39% and 0.9% each. And shares in Asia Pacific were mixed in Monday trade as China kept its benchmark lending rates unchanged. The Hang Seng index in Hong Kong dipped to 0.42%. Hong Kong listed shares of JD.com and NetEase gained 1.87% and 3.02% each, following a Friday announcement that the two stocks are set to be included in the benchmark Hang Seng index from December 6. In mainland China, the Shanghai Composite rose 0.65%, while the Shenzhen component advanced to 1.161%. In Japan, the Nikkei 225 fell 0.2%, while the Topix index declined 0.25%. Over in South Korea, the Kospi gained 1.21%. Australian stocks declined as the S&P ASX 200 fell 0.39%. And U.S. stock futures rose in early morning trade ahead of the holiday-shortened week, a historically seasonally strong period for Wall Street. Futures on the Dow Jones Industrial Average gained 115 points. S&P 500 futures and Nasdaq 100 futures also both traded in negative territory. U.S. markets will be closed on Thursday for Thanksgiving Day. The stock market closes early at 1 p.m. Eastern Time on Friday. Stocks have a track record of posting gains in Thanksgiving week, which will potentially set the stage for a year-end Santa rally. One big market-moving event this week will be President Joe Biden's nomination for the next Federal Reserve chief. Biden is expected to announce his pick in the coming days, with current Chairman Jerome Powell and Governor Leigh Brainerd considered the most likely candidates. Many expect a more dovish central bank if Brainerd prevails, meaning it will take longer to tighten policies, including raising interest rates. Meanwhile, in the UK, EY says the economy will grow slower this year and next year than previously hoped, as ongoing supply chain disruption and rising prices drag back growth. Let's see how that report is being chewed at the market, and more intraday update from Juliana. Hey, Juliana, good afternoon. A beautiful week to you. Well, EY has cut UK growth forecast, now sees UK GDP rising by 6.9% this year, down from 7.6% forecast in the summer. Is this in line with markets' expectations?
Good afternoon, Chimize. Yes, slightly. I think the 6.8% expected this year. It's still pretty high, really, especially if you compare it to some of the UK's G7 counterparts. But as you said, it's still a downgrade. Nevertheless, the EY Item Club, they've published their autumn forecast, and they label a number of things, really, that have downgraded the UK's economic outlook for this year from when it posted its previous forecast in the summer. One of them, and I think probably the most pertinent issue, is sustained inflation. It's running almost double, in fact over double, the 2% target from the Bank of England. Wholesale energy prices, even though they've fallen from some of the highs we saw in September, are still relatively high. And also the supply issue. Not only is the supply issue a factor affecting all major economies across the world, it's particularly hitting the UK because we have this issue of HGV drivers. The British government have tried to sort out emergency vehicles, emergency visas for workers to come across from Europe. But considering Europe also have its own shortage of drivers, the uptick that was expected hasn't actually been in place. Next year, when the UK is expected to finally get to its pre-pandemic level in Q1 2022, EY have also downgraded their growth for the year from about 6.8% to about 5.6%. So even though this was in line almost with expectations, it's not as great as it was in the summer. But, however, we can rely on the fact that we have a wholesome labour market at the moment, which, of course, is one of the reasons why GDP still will remain strong.
In the meantime, the pound hit 21-month high against euro this morning as Austria's new lockdown worries the markets. Bring us up to speed with intraday market numbers.
Yeah, well, the FTSE's started off pretty strong this week, especially, as you said, you know, we've seen major protests across Europe as the new lockdown restrictions and vaccination mandates come into place. This is the fourth wave that Europe is seeing. Some cases of COVID-19 are rising seriously, and there have been some lockdowns in borders. There was lots of mulling late last week on whether or not we would be seeing Plan B take into action here in the UK. But the good thing about Britain is that it has a very high vaccination rate. Almost 90% now of adults have received 2 doses of the vaccine. And of course, we've got this booster vaccine. So this is the 3rd shot of the COVID-19 vaccine rolling out across the country. I believe now over 40s are being invited in to take that vaccine. Of course, if we put our minds back a couple of months ago, Chimeze, we were talking about the issue that the EU was having with AstraZeneca. And because there was that spat for a couple of weeks, they are behind. They're behind with the vaccines, which is why we're seeing this surge. So a lot of health officials have been speaking to the press over the weekend in Britain, and we don't expect that 4th wave to hit UK shores. Obviously, fingers crossed, and I think that's why the markets are up in London today. The FTSE All-Share is up 0.27%. The FTSE 100 is up by 0.33%, and the FTSE 250, the domestic market, that's up by 0.10%. In currencies, as you were saying, the British pound is flying high against the US dollar. Slightly up by 0.01%, but it's also up on the euro by 0.06% and up yet again on the Japanese yen by 0.83%.
All right, it's the week of Black Friday, and of course, police and banks are warning consumers to be vigilant when shopping in this week's Black Friday sales. With a rise in scams expected to cost shoppers millions, what does the high streets look like ahead of the Black Friday?
One word, I'd say busy. It's pretty busy, actually, on the high street. But anyone watching in the UK would know that these Black Friday deals are being promoted weeks and weeks in advance. The official day is, of course, Friday, the 26th of November. This isn't a British holiday. It's been imported from America, of course. The day after Thanksgiving, everybody goes out and spends all their money. We have a similar thing here on Boxing Day, which is the day after Christmas, of course. But it's been going pretty well for a number of years here. This year, I believe, is expected that Britons are going to spend £10 billion on Friday alone. The bulk of that money will be spent online, and that is one of the problems. HSBC and a number of other banks have warned customers to be very, very vigilant when you're trying to look for the best deal. Apparently last year, this is according to Action Fraud, a forum that checks how people are being scammed. Over 28,000 individuals reported that they were scammed to the tune of about £20 million. And now that's a lot of money. So, of course, banks are asking customers to be very, very careful because, of course, in all of those cases, you're not going to be able to get your money back and you won't be able to get the item. But, yes, it's a big day ahead. Of course, on the Monday preceding that, you have a Cyber Monday where, again, billions of pounds are going to be spent on consumer goods. But a lot of retailers are issuing warnings. We do have this semiconductor chip shortage. So, yes, you may want to buy an Apple iPhone or, you know, a Huawei, a laptop, but will you be able to get your hands on the goods? That's the issue. A lot of people are not expected to be able to order something and get a next day delivery this year because of the supply shortages. But people are still going to be shopping. So do send me your list, Chimmy. I'll make sure I'll try and get you a gift.
I love that offer.
I
love that offer. I'll be sure to receive it. Thank you very much, Juliana.
Thank you.
Okay, on the global oil market, crude oil fell to 7-week lows in early trade today, extending declines after the previous session's slide on concerns about excess supply after Japan said it was weighing releasing oil reserves and over demand from a worsening COVID-19 situation in Europe. Brent lost 57 cents to $78.32 a barrel, and U.S. West Texas Intermediate crude futures were down 39 cents at $75.55 a barrel. WTI and Brent prices hit their lowest since October 1. Earlier in the session, they slumped around 3% on Friday. Japanese Prime Minister Fumio Kishida signaled on Saturday he was ready to help counter soaring oil prices following a request from the United States to release oil from its emergency stockpile. Meanwhile, concerns are growing that renewed COVID-19 curbs could hit demand. Gold prices stabilized in early trade after hitting their lowest in nearly 2 weeks as a retreating dollar lent some support to the metal. Spot gold was later chained at $1,845.48 per ounce. U.S. gold futures fell 0.3% to $1,846. The dollar index fell 0.1%, retreating from Friday's high. A weaker dollar reduces bullion's cost to buyers holding other currencies. In other metals, spot silver fell 0.1% to $24.57 per ounce. Platinum eased 0.6% to $1,025, and palladium dropped 0.7% to $2,047. And to all the stories here on the African continent, the U.S. President Joe Biden has been asked to get personally engaged in a long-running fight to enact an intellectual property waiver for COVID-19 vaccines at the World Trade Organization, calling his leadership a moral necessity. This call is from 15 human rights groups, including Amnesty International, Human Rights Watch, Oxfam, and Public Citizens. In a letter to President Joe Biden, the group stated that an emergency waiver was urgently needed to combat the pandemic, noting that fewer than 7% of people in low-income countries had received a first COVID-19 vaccine, and vaccines remain scarce. Biden reversed the previous U.S. position to endorse a waiver in May, a move that caught some allies by surprise, but there has been little progress since then. The European Union, Britain and Switzerland remain opposed, arguing that issuing such waiver would undercut years of investment and research. All right, let's cross over now to Europe, where stocks were cautiously higher in the morning, shrugging off concerns over COVID-19 restriction measures on the continent. For more, here is Chiponda Chimbelu joining us from Berlin. Hi, Chipone. Good afternoon. Good to have you on the show.
Good afternoon.
So, tighter restrictions in Germany and across Europe are worrying investors and businesses. How are the markets reacting today?
Well, in terms of restrictions, in terms of what we're seeing in the markets today, we're basically seeing that the markets are trading at pretty much fairly the same levels they were at on Friday. And on Friday, they dropped for the first time in 7 weeks. And of course, there's a lot of fears around the COVID pandemic here in Europe. We've seen countries, coming in with tougher restrictions. In Austria, there's a lockdown. In the Netherlands, in Belgium, and here in Germany, there's of course also tougher restrictions, to combat the high COVID infection rates that we're seeing in those countries. And here in Germany, for instance, in the German state of Saxony, what we've seen is that, they are trying to crack down on people who have not been vaccinated, and they cannot, for instance, go shopping. But that's something, of course, that's going to concern investors, because retail activity was fairly big contributor to the economic recovery in the third quarter of this year. And so that's something that is worrying investors, just how much will, the current lockdown affect retail activity. And of course, we already can speak of supply chain concerns, which we've had already. And so there's a lot of concern about whether the lockdowns that we are seeing right now will be affecting retail activity and just how much that might play into the economic recovery.
And Europe thought it has passed measures like nationwide lockdowns. Is what's happening in Europe enough to send economic recoveries into reverse?
Well, in terms of what we can see in terms of the lockdowns, the analysts, at least, are saying that the expectation is not that these lockdowns might be as severe in terms of economic impact as the last ones we've had. And that's because policymakers have been learning with each lockdown how to respond with measures that can help businesses and also help people. And that, of course, helps to prop up the economy as well. So the expectation is that even if we might see some sort of impact, it will not be as bad as we have seen earlier. But they're still warning that in terms of economic recovery, we might see the economy stagnating or perhaps even retracting. And today we have some new figures from the German central bank, the Bundesbank, and they have said that they expect GDP growth to stall in the fourth quarter. And of course, that might be potentially linked to the current lockdowns, and of course, the fact that we are not seeing economic activity being able to come back to the levels it was pre-pandemic, because of course we're still fighting with the spread of the coronavirus, and now of course with an extremely high level number of cases here in Europe, the highest we've seen in some parts of the continent, Germany and a couple of other countries.
Thank you very much, Echpono. I guess we'll leave it at that. Hope to see you tomorrow, and enjoy the rest of the day. All right, we'll take a break now. When we come back, we'll look at Tanzania's economy. That and more in a moment. Just before we go to Tanzania, the revival of tourism post-COVID-19 will dominate talks when South Africa President Cyril Ramaphosa hosts his Kenyan counterpart Uhuru Kenyatta for a 3-day official visit. The two countries' economies contracted after being pummeled by the impact of the coronavirus crisis that hit key sectors like tourism. President Ramaphosa will host the Kenyan leader, who arrives in Pretoria today at the Union Buildings in the capital before the two leaders head to Transnet Engineering in Kodosport. The Transnet engagement is aimed at providing an ideal opportunity to showcase South Africa's capability in the supply and maintenance of rail-related technology. Memoranda of Agreement on Cooperation in International Cooperation and Relations, Home Affairs and Tourism are expected to be signed. All right, let's look at Tanzania now. The economy grew at 4.7% in the first half of 2021 compared to 4.9% for the same period of 2020. Inflation remained within the target 3 to 5% and revenues performed satisfactorily. This follows IMF's executive board approval of $372.4 million rapid credit facility disbursement to the country to address the COVID-19 pandemic. Tanzania continues to experience substantial challenges from the COVID-19 pandemic and faces an ongoing urgent balance of payments needed as the authorities implement a comprehensive emergency response plan, including a vaccination campaign. All right, let's talk about this now with Matt Kindiger, Associate Practice Lead, Sub-Saharan Africa at Frontier View. Hey, Matt, good to see you. I missed you, by the way, Matt. Good afternoon.
Hi. Hi, thanks for having me on the program again today. Yes, I've missed being on the show over the last couple of weeks, so it's good to be back.
Good to see you. Well, what does the second quarter data tell us about how Tanzania's economy is performing?
So generally, the data that we've seen coming out of Tanzania for Q2 is quite positive. The economy is continuing to expand, delivering pretty consistent growth. It's similar to performance last year. And this consistency in performance is quite exceptional by sub-Saharan African standards. And this is because, most economies saw quite a substantial economic shock last year, but Tanzania has continued to deliver quite upbeat growth, and this continues in the second quarter. And as you've mentioned, inflation is also very low, which is very positive. Again, many African countries are seeing a very sharp acceleration in inflation, and so the very low and stable inflation is broadly very positive for the economy and a reflection of economic progress there. In particular, we saw very strong performance coming out of sectors like ICT and hospitality, but there were a couple of sectors that didn't perform well, including agriculture and construction. So those are a couple of sectors worth looking at and monitoring, and it does suggest that there is some hesitancy amongst some investors in those sectors. But overall, the economic data was relatively positive that came out.
So how does the IMF recent funding affect the outlook for Tanzania's public finances?
Yeah, so this is quite a significant development, quite a positive development. I can't state enough how significant it is in terms of what it represents for Tanzania's standing internationally. It represents quite a significant shift to how Tanzania was engaging with international institutions just 6 months to a year ago. So this reflects the change in Tanzania's standing globally under the new president. But it's also very positive in the sense that Tanzania does face a bit of a balance of payments and fiscal crunch at the moment, and this is because the government is taking COVID a lot more seriously. For a very long time, it wasn't paying direct attention to the pandemic, but now it is paying much more attention to expanding the rollout of COVID vaccines, providing much more support to the public healthcare system to ensure that it can cope with future COVID waves, as well as deal with the impact of tighter COVID restrictions that have been introduced in Tanzania. So really, it is quite a positive development. It shouldn't be interpreted as Tanzania facing significant stress or pressure, although we are expecting some fiscal pressures to emerge. It really is a positive development in our view that the IMF has become involved.
And how will President Samia Suluhu's leadership affect the country's economic prospects?
Yeah, so, if we look beyond COVID and we look at the new, the relatively new president and how she's managing the economy, generally it is again positive. She's been really instrumental in getting this IMF deal through the door. She's also demonstrated that she's very keen to engage with the African Union, the East African community. So she's really focused on raising Tanzania's standing globally. We're expecting to see much more transparency when it comes to data releases from Tanzania as a result of her leadership. And we've also seen quite significant progress towards things like economic reform and infrastructure investment from the public sector. And private sector businesses, the companies that we speak to, are sitting up and paying much more attention to Tanzania as a result of her new leadership. However, there are some risks. So she is taking COVID more seriously. We are expecting tighter COVID restrictions. There have already been new tighter COVID restrictions over the last couple of months. So this could affect some sectors such as hospitality and accommodation. But overall, we are generally quite optimistic that the economy should grow by about 5 to 6% next year after a moderate slowdown in 2021. So certainly 2022 is looking a bit more upbeat for Tanzania.
Thank you very much, Matt. Always a delight speaking to you on the show. Enjoy the rest of the day.
Thanks again. Thanks.
And finally, Senegal has signed construction deals worth $1 billion with U.S. companies, including for a highway linking the capital Dakar to St. Louis. This is according to the Secretary of State, Antony Blinken, who arrived in Senegal on Friday following stops in Kenya and Nigeria during his first official visit to Africa. The money would also be spent on bridges, improving trade corridors with neighboring countries, and a nationwide communications network for emergency services. And that's it on the program. Thank you for watching. I'm Chimeze Obi.